Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the No Trader Show. Well, look, we enter the final quarter of the year with several key markets unwinding some of recent months' gains. Let's start with stocks. They're still in pullback mode after the S&P has now potentially double-topped just about 3,025. As I speak, it's trading 2960. U.S. 10-year rates, which bottomed in the summer at 1.45%, are at about 1.65% and recently saw as high as 1.9%. Gold had a massive rally in spring and summer, but is now, in fact, today, gold had a kind of a clean out to the downside, getting down into the 1460s. It's back to about 1490, so it's at a good bounce. But it also is just beneath what we would look at as being the support level that we saw over the bulk of the summer in the mid-1490s. And certainly the crude oil market, which just 3 weeks ago had gotten over $63 a barrel on the Saudi oil field drone attack, has slid all the way back down to about $54, even lower than where it was on the night before the attack took place. That makes this fourth quarter potentially more interesting and even more volatile than we've seen up until this point this year. So today, we're going to take a look at the macro sectors like we do each week, and we'll look at the S&P. And then today, I figured we would take a look at the financials part of the market. We haven't looked at them for about 3 months or so. In fact, I think it was just about early July the last time we looked, so it's a good time to do an update. And they're close to getting a relative breakout to the S&P. So when you look at sectors, not only do you need to look at them in absolute terms, but also you want to see which ones are outperforming and underperforming the market, because generally you want to get long names that are outperforming the market or about to outperform. In other words, breaking out to the upside from a relative performance chart. And the simple way to do a relative performance chart is simply pull up the ticker that you want to compare to the S&P, and depending upon what charting system, you'll either divide one by, usually you'll divide one by the other. So in this case, let's say we'd look at XLF divided by the S&P, and that chart will show the relative performance. So if the chart's moving higher, it means that financials are outperforming the S&P. If the chart's moving lower, it means financials are underperforming. So we're going to take a look and get through a bunch of names in the space in order to look at, if we get this upside breakout, which ones are the best financial names to be in. So we don't have it yet, but with a little more outperformance, you could really see a move into financials. Now, what would cause that? You'd really need a somewhat consensus view on the street that interest rates have indeed bottomed. And that's certainly up in the air, and that's why these have not broken out to the upside. But we'll go through as many of these names here, JP Morgan, Bank of America, et cetera, that you see on this list, and we'll try to go through as many of them as we possibly can. The best way to contact me is rick@inthenotrader.com. Check out our website at inthenotrader.com. We have several videos up on both tutorials on models we use, interviews I've done, etc., as well as information to find out how to become a subscriber. So let's first take a look at, as we do each week, comparing where the 11 macro sectors are in relative performance to the S&P this past week and 2 weeks ago to see what's changed. And I highlight with this week we have 5 of the 11 sectors have red dots next to them. That means that those have moved more than 1% in relative terms from the prior week. So for instance, this week, coming as of last night's close, commercial communication services are up 2% better than the S&P this year. They were up 3.8% coming into last week, so therefore they lost 1.8%, so they've gotten hit in relative terms. Energy actually got smacked in the last week. Of course, the price of crude oil comes down, so a lot of the bidding that had gone into the energy space has come out because oil, as I mentioned, has recouped and even gone down more than where it was at the time of the drone attack. So it's lost more than $9 off of its peak, and therefore you're seeing more selling coming into the energy space relative to the S&P. You've got consumer staples, which a week ago were only up 2.2% or so. They're now up 4.5%, so they had a significant week of outperformance. Healthcare remains the dog of the S&P and even got worse last week, now down 13.3% versus 12.3% the week before. And utilities picked up over the last week, now up almost 6.5% versus about 4.2%. So you're seeing a little bit of movement into the defensives, and energy with oil getting smacked really was the big loser. Okay, so let's take a look at now charts. So as we do each week, we start with the S&P to make sure you know what I'm thinking about the broad market. This is real time, so you can see we're trading at 2963. Little small bounce off of the low of the day, but the most important thing here to notice is not only did we get a sequential 13, very close to all-time highs in the middle of July, but the test of the highs, and this is what's most important, it's September, peaked on a setup 9 count. Again, that's 9 consecutive daily closes, that the close was above the close from 4 days prior. The fact that that 9 count came in at a price beneath what was all-time highs of 3,028 had me tell clients to lighten up long exposure. We have just a minimal bullish bias in the market for tactical trading, and just slightly more for longer term perspective, but I'm not thrilled with the double or the chance, let's call it the chance of a double top. It's not a formal double top yet, but we certainly stopped right in the same neighborhood as what had been the July highs. The key levels I'm looking at here is the 2911 level, which is the propulsion level on the downside. You can see in August multiple times we got beneath that level, but never correctly, what we call a qualified and confirmed close beneath, as developed by Tom DeMark. The other key level is 2888. So I'm using breaks underneath these two levels. If we get a qualified and confirmed break beneath 2911, we're already getting defensive, more so under 2888. Has nothing to do that happens to be where the trend line's value is right now. These are models that suggest that breaking these in proper ways would suggest further downside to come. So I'm going to lose all my bullish bias in the market if we properly break these levels. If we do, the next target down would be 2794 to 2744 or so. So essentially coming back down to that double bottom we saw earlier this year in March and June. On the upside, we need to break above 3,064. That's about 1% above all-time highs in order to then next target about 3115 to 3136. So that's the way we're looking at things now. So market's off, today. We haven't broken down enough to really get concerned, but we're also not that far away. We're kind of midway in between the recent high and where we really get concerned in the bigger picture. So that's our view on the S&P. All right, so here's our first slide. This is the relative performance of XLF, the S&P Financial Index, versus the S&P itself. And you can see since over the summer, we essentially have kind of a triple top in here as recent as just last week. And what we really want to see is a breakout above here to then get to higher levels. Right now, even today, financials are underperforming. So you're seeing this, hook downward and head down. And it wouldn't surprise me if in the next several days to week, we come back down and kind of test the confluence of these two trend lines, both the uptrend line from the August low and then pulling back to this bigger, longer term breakout that we broke out from. So right now, I'm not saying to go into financials, but if you monitor this and we get above this blue line, then you're going to want to probably allocate some money to the financials. And what I figured we do is, because this stuff can change fairly quickly, let me give you a sense, looking through a bunch of the key names in the financial space, of which ones have the best chance of doing well on a breakout. So we're going to start off with usually what these days most people would think of as the predominant financial name, JP Morgan. And these are weekly charts that we're going to look at by and large. And so we'll default to weekly charts unless I need to change. So what you can see here is going back to January of 2018, which is in this kind of right here in the middle of the chart where I'm highlighting, the stock's gone nowhere. Now, clearly it's near its highs, but this has really been in a trading range from somewhere between 115 and 120 on the upside and kind of 100 to 105 on the downside. We had that big move down here last December, but the bulk of the trading, is in this zone. We see multiple sequential 13 weekly signals here suggesting upside exhaustion. And each time they came in, you'll notice from since many stocks peaked in the first quarter of 2018, you basically have, each time we get a 13, you've had a pullback from them. So again, this model, the sequential model developed by Tom DeMark, is one of my favorite models to incorporate into my analysis of markets. Many institutions use this model, and it's no surprise that you're seeing pullbacks when these come from, because generally smarter money is playing off of it. At this point now, a qualified and confirmed Friday close beneath 113.35 would initially target 106 and change, and in a bigger decline, 92 and small change, which would essentially test the Christmas low. Is there any reason to think a stock like JP Morgan would test the Christmas low without more troubles happening across financials, across the stock market in general? I don't think so. So, this target down here at 92.18 really would be significant if we got to it. And if we did, things are pretty bad out there. Rates are probably collapsing and 1% or lower on the US 10-year. I don't think we get there just in the midst of stocks correcting themselves unless rates take out that triple bottom at 1.4% plus or minus 10 basis points, that we go all the way back to 2012 and the all-time lows. So there isn't a heck of a lot to do here as far as buying. On the upside, this really needs to break out north of anywhere from 126 to the 127.5 or so to then project to 140 and higher. So it's kind of a tough place. If you're aggressive and you like the prospects for banks over time plus the stock market, then if we were to get down only about $4 lower, $3.50 lower than current, I'd say anywhere from, let's say, 113.5 down to 106.25 is where you'd want to buy the name. And that's, again, coming from if you have the feeling that this is still a consolidation that's going to come out towards the upside. Next name is Bank of America. You can see here, if you just take a look at recent action relative to the highs, you can see Bank of America peaked again in the first quarter in February of 2018, hasn't gotten back there since. If I just quickly flip back to JP Morgan, you can see that we got essentially right back to what were the highs. So a month ago, we got to 120.4. And that actually made a new all-time high by about $1, and it's pulled back. So compare that to what Bank of America looks like. JP Morgan is technically a stronger name. Still, we're going to see lots of these names. The bulk of the names, certainly in the big bank space, are going to be sideways patterns. Same type thing here. 13's near the highs, pullbacks, but this hasn't broken down. Last week was a down close relative to the week before. So even if this week closes beneath 28.57, it's not going to be qualified, just like all these other times that we broke beneath it. If this week we close down from last week, next Friday close higher on the week, and then break through, then you up the odds that you trade down to 25.95. So let's just call it 26 and test this level. And its bigger downside level, comparable to what JP Morgan was at 92, gets you all the way down to 20.78. And again, that means you would have taken out the Christmas low. And to me, that only happens if there's a big bid back into bonds, interest rates collapse, or something else in the world goes terribly wrong. Wells Fargo certainly got some big news last week with a new CEO. Now, this having been one of the weakest banks, you'll see that you've got 13 signals underneath price action suggesting downside exhaustion of trend, just like it had done back in the middle of 2016. So here you're getting some signals that you have downside exhaustion. It actually got good news last week. That was the thrust up here. Markets coming off this yesterday and today. So that's why you're seeing some of the down move here. It is a name to consider on the long side because they've got a new CEO, and this has been a beaten down name, and people have been waiting for some type of potential change. The person who comes in came from Bank of Mellon and proven successful there. So this is one of the cheaper names that you find in the space that may have some more upside to it. So no real signals right in your current price action. Let's see. So first upside target would be about 54.5, then 59.5, and then all the way up at 66-ish, almost essentially testing all-time highs. So in relative terms, this may be a name that you want to think about. If you've got one of the other big bank names, you may want to kind of swap some into this and maybe take some profits in the other ones. Citibank. So weekly 13 at the beginning of, or somewhat towards the beginning of the summer, right here in early July, we pulled back, we rallied, and now we're kind of hanging in here. Same type thing, all-time highs made in first quarter of 2018. I'll tell you, I kind of feel the same way here. In order for us to test last Christmas's low, things have to get really bad. It's not going to come from Citi alone. It would probably come from a bigger stock market sell-off. Which again would come from potentially rates at this point really coming down, and people again going back into treasuries and kind of locking safety and giving up stocks. Otherwise, none of these are kind of buys right now. None of them that we've looked at so far, at least of the four we've looked at, have fresh new signals. If Citi can get a proper Friday close above 72.98, then it has room to get all the way up to 85 over time. So this is kind of also somewhat neutral and a little bit like don't love it, don't hate it, don't love it. Let's get to some of the regional banks like PNC. So also this topped all-time highs, 13 and 9 combination. A couple of weeks later, tested the risk level. That's where it would say that looking for a high from these signals would be wrong. We went right to them, didn't break above them, and the big down move for the bulk of 2018, recovered a good half of it, and now it's stalling. Same thing, no particular signal here other than we've stalled against the propulsion exhaustion level at 140 and small change. Getting above this on multiple Friday closes then gives you a chance to get up to 158. Otherwise, we kind of have the chance for a near-term double top here. This is also kind of trading oriented. Proper Friday closes underneath 130.5 would then target 116.76. So another kind of mid-range stock that, financial is not doing a heck of a lot. Other than recovering and moving somewhat with the market, but having a tough year with interest rates doing what they've done. BBT also just failed again, so we got to the propulsion exhaustion level. So this model propulsion basically said when it properly broke above 47.27, which it did this week back in early June, it would have enough thrust to get to 53.86, and that's essentially where we got. Look at what this week's high is, 53.90. So it exactly hit the propulsion target. It's pulled back from here. Key level right now is staying above 49.99. If we were to break under 49.99 even this week, and then open lower next Monday, and took out this week's low, it would target 46 and change, and then all the way down on a bigger sell-off to 38. And again, that would have to take out the December low. So that would be, again, on bigger issues. Getting multiple Friday closes above 53.86, then would target initially 58.5 to about 60. SunTrust. Similar looking chart, stalled against the propulsion exhaustion level, kind of hanging here. Downside, be wary of a move under 62.31 that's qualified. That would suggest, if it did, it suggests 55 and change. On the upside, this really needs to get above these highs here from the summer in order to next target 90. Otherwise, you're in no man's land. Berkshire Hathaway, like most financials, totally in sideways price action. A couple of 13s here indicating near-term tops. You get 1 month sell-offs. This is completely neutral, nothing here of significance. Total neutral name, no opinion on it beyond that. American Express. So this actually made this summer. These are all-time highs. It's accompanied with an upside exhaustion signal a couple weeks before the actual high print. I've sold off since there, did a 9 count to the downside, failed against breaking out above 120-ish, and continues to have a little bit of negative bias. So here, if we get a couple Friday closes underneath 116.60, then this targets 103. And notice this is the first one we've looked at that has, because it's been so strong, this actually has a full propulsion exhaustion signal that's well above last Christmas's low. All the other ones we've seen have been beneath, which makes this one of the technically best names to own, and has been, the best name that we've seen so far. So I would say the next few weeks are rather important relative to this 116.60-ish level and whether or not we can hold above it. And also, if we break beneath it, was the week before we broke beneath it an up close. So for instance, last week was an up close relative to the week before. That makes this week qualified if we close underneath here to potentially open the door to get down here. So that would be qualified. If we break underneath it this Friday and close underneath it, this 116.59 level, and next Monday, gap lower on the open, and anytime next week, trade beneath this week's low, then you have a fresh signal that would say there should be enough momentum to get this down to, near 104. So this one's kind of really important too. Notice I'm not looking at trend lines. I can add those, and we can do other type analysis that's more conventional. But here I'm just trying to give you a sense of what some professionals notice. In fact, that the uptrend line caught the Christmas low, and depending upon how long it would take for us to sell down to 103 from 117, which on a percentage basis is pretty hefty, we might very well come into where that trend line is, as we head into, let's say, December timeframe. So American Express, the darlings so far of all the names we've looked at. And the only thing, short term is its inability to get back above 120 3 weeks in a row suggests that the stock is stalling and still faces some potential downside pressure. CapitalOne, this is kind of a weird place to see a 13 so high off of the low. So mathematically, it's showing a 13. Doesn't mean that I'm looking for downside exhaustion there, because I can right away spot that it's not a kind of a conventional 13. Look here, 13 bottom, 13 bottom, 13 high into a 9 correction, 9 high, 13. This 9 stalled for a little bit, made a 13 in a rally, and now you're getting a 13, but it's mid-range. Tough to call. Last week was a down close relative to the week before, so that means if we close underneath the propulsion level this Friday of 89.47, it's not qualified. Doesn't mean it can't get down to 80 and change, but it means I can't quite play it to do so. So here too, mid-range, stalled against propulsion level on recent rally. The prior rally stalled against the propulsion level, and this one didn't quite get there. So neutral name, if you like it and you're a trader, well, let's see, down, up. Okay, so here's, before I move on, let me tell you what I would do with this. If this week closes beneath 89.81 and next week closes above 89.81 and the following Monday gaps higher and takes out this week's high, this coming week's high, then you get a fresh buy signal. And then I would play this to potentially even measure new all-time highs. So this we watch for a couple of weeks and see how it plays off of these propulsion levels, because there are signals in either direction that haven't kicked in, but certainly could. What should we move to? Let's look at Morgan Stanley. Morgan Stanley potential double bottom versus Christmas. So this is one of the weaker names that it's come back to essentially test the same range of the week that made the low, right? So the recent low here in August fell into the same range of the week that made the low in December. So technically a weak name. Certainly, there's some sense of a downtrend that we can draw from the highs. With 3 hits on this downtrend line, I would say, it's not a perfect channel, but I would say there's something, this could certainly fall to under 35, take out the Christmas low. So it does right now have an active propulsion sell signal. So it minimally targets 37.34 on the downside. No reason to pay 41.5 right now for it. It needs to get proper Friday closes above 46.30 to then target 55 and change. Notice we got above it there, but we closed above the 46.30 level after a week that was an up close. That made this not qualify, and therefore you didn't play for the breakout. So I need to get above there properly in coming weeks to be bullish. Otherwise, right now, Morgan Stanley looks heavy. Let's look at Goldman Sachs. Get rid of some of these trend lines. So we see Christmas time, a week or so or 2 weeks before Christmas, we have downside exhaustion held right against the TDST line. So perfect buying opportunity here. Gets a propulsion buy signal, says if we get through this level properly, it has enough thrust to get to this level. That's exactly the peak of the move. So right now, too, you're in between the next 2 signals. If this week closes down on the week, which right now it looks like, then if next week we close above 211.35 and open higher the next Monday and take out next week's high, you target 230-ish. So that's a decent trade. You'd need to get an up close the week before we break under 191 to potentially test those Christmas lows. And we'll do one more stock. Let's pick something in the insurance space. We'll take here, Marsh McLennan. So insurance stocks, especially this one, made all-time highs earlier this summer. We're hanging out near here. So like American Express, this is one of the premier names in the space. Certainly could, see some profit taking, but if there's a name that you want to be holding, this one clearly is better than almost every other name we looked at. So that's a look at financials this week, as well as what's going on in the S&P. Good trading, and we'll be back with In the No Trader next Tuesday. Have a good week.
This is a little info demo to show you how to put a solid line or something like that on the top of an indicator that you might already have. When you scroll down here, it was on the SCTR line, but I want an overlay of a horizontal line. And in this case, I can set it up so I put the line at 75 on the indicator SCTR, and using the colon symbol and then the word blue, it'll put a blue line up there for me like this. So if you're looking to do overlays, just those simple little tools, but use the colon command to help color it.